Welcome, and thank you so much for joining us in this session today to talk about obstacles and overcoming those obstacles. I'm Rebecca Price. I work with Investor Circle, and we are a network of foundations, family offices, and individual angels that invest in early stage companies that have a social or environmental positive impact. And I'm really, really excited to have this amazing panel here today to talk about all of these obstacles and overcoming these obstacles. And this morning we heard from a really fantastic panel as well, who addressed kind of the higher level, more kind of strategic obstacles. And here we're going to get way more tactical and address some of the actual obstacles and then some of the solutions to overcoming those obstacles. So I'm going to have the panelists introduce themselves just briefly. Then we'll move into a few questions, but then really want to create a discussion atmosphere. You're at small tables, so we want to really encourage you to ask a lot of questions. We do have a few mics floating around, and we ask you to speak into those mics because the session is being recorded. But we do really want you to engage with the panelists. So I'm going to start with Sara. Sara, if you can just briefly introduce yourself.
Sure. I think a good way to summarize my background is super male dominated. I have a bachelor's, master's, and PhD in mechanical engineering, and then spent 20 years in the semiconductor electronics kind of tech industry, whether it was directly in technical roles, in strategic management consulting at McKinsey and venture capital in the Bay Area, or in like operational roles at companies. And then I started a brewery with my husband where we employ pretty much all bearded men. And I have 2 boys. So now what I'm doing is I'm managing a venture capital fund, me and another woman GP, to invest specifically in women-led companies in the sustainable consumer and consumer health areas where women make the vast majority of purchase decisions.
Well, based on Sara's background, I would describe mine as uneducated. Only have 1 degree, but anyway, I'm Ally, and I'm the CEO and co-founder of Work Capital. And Work Capital is an ESG and impact-only asset manager and distributor. Our mission is simple. It's performance with purpose. And that's what we like to deliver to our clients in the form currently of public equity strategies, thematic ESG strategies. And our clients end up being foundations and endowments and institutions and high net worth individuals, but we deliver those mostly through consultants and the intermediary channels. Excuse me, I've got a little post-nasal drip today. So we don't provide wealth management services. We really provide the asset management products. And we're also in the market, for those of you that are here, to partner with other great managers that think about authenticity and rigor when they're creating their products, whether they be private or public. So we're looking to partner with good managers and bring them out to the marketplace.
Good morning, everyone. I'm Erin Harkless with Cambridge Associates. Apologies a little bit similarly. Blame my almost 1-year-old daughter, I think, for transferring some baby sickness to me, but I'm feeling better. Just still sound a little nasally. But it's great to be here. Cambridge Associates, we're a global investment consulting and advisory firm working with nonprofit institutions, foundations, endowments, high net worth families, family offices, and pension funds to invest their portfolios. And specifically, I'm a member of our mission-related investing practice, 35-member group spread across all of our offices globally, where we directly engage with our clients who are seeking to integrate impact and mission into their investment portfolios. So really excited to share some of those stories with you today, the things that we've seen with our clients. And again, kind of my role on this seat is directly engaging with asset owners and helping them invest and implement their strategies.
Good morning. I'm Melissa Cheong, and I'm the Chief Investment Officer at Zoma Capital, which is the family office of Ben and Luciana Walton. Ben is a Gen 3 member of the Walton family, and he and his wife, Luciana, have decided recently to transition all of their assets to an all-values-led investment strategy. So I joined them last year and have been in the process of facilitating that transition and supporting the family as they've developed their strategy and worked towards implementing, towards areas that are, true to mission for the family. And prior to being with Zoma, I was with a firm called Imprint Capital, where I led their direct investment and private credit platforms and also worked on the client management side. So I've worked with family offices and foundations and financial institutions to create customized impact investment portfolios for the last kind of 8 or 9 years. And I'm happy to share some of the experiences that come directly with working with a family who's trying to put impact capital to work at scale, which is really hard. And then also to talk about some of the other work that I've done with different investors in my role at Imprint.
Great, thank you. Now that they've all introduced themselves, it would be great to have a sense of kind of who's in the room today. So just quick show of hands, if you come from a foundation. Okay, a few foundation members. Asset owners. Okay, general kind of intermediaries. Few. And then kind of general practitioners in the field, impact investing. Okay, great. So nice selection across those kind of different categories, and that's great to know. And our panelists will address kind of those different audiences. They come from a range of backgrounds and kind of can speak to a bunch of those different places that you all come from as well. So this morning, Lori Spangler spoke about kind of the need to jump right in and get started and take that leap of faith and make that commitment to making an impact investment. And so our panelists here are going to really be able to talk to that, how they are getting started with their different constituencies. So we're going to start with Sara. Can you tell us just a little bit more about kind of what have been some of your greatest challenges in engaging investors in this journey? From the VC perspective, you're dealing kind of not with these massive institutions, but kind of smaller investors, angels, et cetera. How do you engage them? What are some challenges there?
So the challenges are primarily that we're a small fund. It's a $20 million target raise. And so institutional investors, large foundations, endowments, pension funds, can't write check sizes as small as we need. And so we are engaging with individuals and family offices and some small family foundations primarily. And so the challenge is that you can't market that you're fundraising. It's all these kind of one-on-one coffee leading to another coffee, leading to another coffee. And so, yeah, it's very inefficient, but for a reason. And so what we found to be helpful, let me just say that over 80% of our investors to date have been women. Women from, a single woman, a woman from a couple, family office, small foundation that has led the investment decision. And that's pretty unprecedented, if not completely unprecedented for a VC fund. So it's something we're really happy about, completely unexpected, frankly, not and maybe the opposite of what we were expecting when we started fundraising. And what we found to be helpful is to have some small gatherings where there's, 10 potential investors in a room to talk about venture capital fund structure and the capital calls, schedules, and what types of companies we invest in, examples of those companies, exit scenarios, et cetera. Do a little bit more of a training, frankly, and to have the group dynamic of the shared questions and answers. So there's not a dumb question, and people can, learn from other people's questions. And so most of our investors, maybe half, are first-time VC fund investors. So it's been really helpful, I think, for the women especially to learn more in community versus, tops down kind of learning style. So that's one way.
Great.
We found.
Fantastic. Ally, kind of with a slightly different group of investors to engage, it's a slightly different process. Kind of what are the challenges you're encountering and kind of how are you overcoming those?
Well, when I think about how many people in the room are financial advisors or are in a role where they're, okay, and how many of you, is this your first conference for impact investing? 2? 3. Okay. So Michael Lear, who was on the earlier panel today, is a friend of mine, so I can make fun of him. But he's saying, 20 years ago, I figured this thing out and everyone should know it. We have a huge issue with education and the control that the financial intermediaries have over assets in this country. And thank goodness for interested investors, because I think in this case, investors are pushing their financial advisors, which is what Michael alluded to down there. But the issue to me is what Darcy touched on, which is she said she had a mindset, right? She had a mindset. She was out there to make her clients the most money, minimize risk, and minimize taxes, right? So that's what you are focused on doing if you're a financial advisor for your clients. And I think us as practitioners and an industry are coming out and saying, okay, how do we create products that look like they're other products but are actually good for people, and so we can fit it into the framework and they'll buy it and they'll believe. And I think what we're missing, because I do this every day and I try to convert financial advisors into this space, I think what we're missing is the conversation that they're having with their clients and them understanding the purpose of money and their client's purpose of their money. We all from financial services backgrounds have this mindset that this is what we are on the planet to do. And the way that clients, and even more the millennials and women, are thinking about their money is the purpose of their money. And so we need to get at this issue with financial advisors to break through. It's not another educational webinar telling them what ESG is and telling them what green is and telling them we need to change their thinking. And that's kind of been my issue and what we're trying to go after in order to get more financial advisors to be in this type of business.
Changing mindset. Okay, so Erin, large institutions primarily is who you work with, a lot of foundations. What are some challenges there that you're seeing, and kind of how are they different from kind of the VC world and kind of more the retail client?
So I'd say a couple of things, and Christina on the panel this morning touched on this concept of education, and Ally, you were just talking about this, I think, tangentially as well. And, one thing that's always tough is that people are coming into impact from different spaces, different perspectives, different levels of experience. And if you have a board or an investment committee, you could have someone who's been doing this for 5-10 years. You could have someone who is like, why are you wasting my time talking about mission and trying to align our values with our investments? So you need to be able to bridge that wide chasm and get everyone on the same page. So a lot of the time that I think, and things that we try and do with our clients, is really have some of those tough conversations and bring the board together, staff, all the different stakeholders, and really lay out, what are our priorities? What are your priorities from a mission standpoint? What are you trying to accomplish with this pool of capital? And be very intentional and memorialize that in your investment policy statement so that when, this one board chair or this one board member who is really passionate about this rolls off in 6 months, the new person that comes on can see all the work that we've already done and continue to foster that conversation. So it's all about education. And then I think governance too. This is probably me being a consultant. You're rolling your eyes saying, well, that's boring. Like nobody cares about governance. But it's fundamental. Excuse me. If you don't have the right set in place for decision making, and Melissa probably can speak to this too, dealing with families, but if you have a single decision maker, if you have a board, you have a committee, whatever it may be, being very clear about how the decisions are made and tying that again back into this process of what your priorities are, because everyone wants to go out and put capital to work. And I think that's important. And as the panel said this morning, we don't want to spend all of our time sitting around gnashing our teeth and in our hands trying to figure out, well, what are we doing? And we're letting opportunities pass us by. And it's exciting to put that money to work, but I think you have to have a really clear framework and honest conversation up front among the different stakeholders, and that's challenging and that's tough. And so it's part of our job to help support that and do that as your advisors and consultants.
Erin, that's an interesting point that you bring up about turnover, that, when there's a new person in place, how that creates a challenge for you in educating them, bringing them up to speed. Yeah. I'm sure many of you deal with that challenge as well. So Melissa, working with a family office and working with Ben and Luciana, kind of how do they kind of come to align their values with their investments, and kind of how have you helped them to overcome the challenge of kind of engaging other family members and kind of moving the family office in that direction?
Yeah, we had a really interesting experience just getting started in that when I came to them, I assumed it would take some time to kind of get them to the point where they were comfortable and ready to kind of jump in the pool. And like right away, there were 10 different things they wanted to do. And so one, there was like the need to kind of embrace this enthusiasm and this momentum and make sure we found opportunities that were going to be rewarding and satisfying to them, but also needing to figure out how to be strategic and to create that structure, because it was so, I think we're all human. Like it's normal to have diverging areas of interest, but at the same time, capital, no matter how much of it you have, it's finite. And so there was a realization that we needed to be more structured about the way we were approaching the work. And so we ended up kind of bucketing these different areas of interest into 5 different areas of interest. So mental and behavioral health, workforce development, renewable energy, water, and community development. And within each of those sectors, there's a lot of overlap, particularly with relation to community development and thinking about place-based approaches to investing in all those other sectors. But we had to step back and then develop a theory of change with relation to each of those different sectors. And so that was a long, hard process. And because it forced us to just ask questions and for the family to ask themselves questions around like, what do they want to prioritize? So what we did is go out and kind of canvass each of those sectors, create systems maps, which, have tons of boxes and lots of words and lots of arrows. And then from there, try to figure out like, what did we want to focus on? Because we couldn't do everything. And although, again, as it's human to want to do a bit of everything, we had to just take some things off the table. And so that was, I think, it was a really good process for us all to go through because I think it built a lot of trust between staff and the family that we were all kind of aligned and on the same page with relation to what we wanted to focus on and what the family wanted to do. But the other side of that, for me as a staff member, it creates challenges in that if we're too specific and you make the aperture too narrow, it's really hard to put money to work at scale and have it be meaningful to the family. And so then, for example, generalist VC and private equity funds like just don't end up being interesting to them because it doesn't actually touch or come close enough or seem aligned enough with kind of their North Star areas of focus with each of our different 5 strategies. So, we constantly have to kind of work through these situations where we have to decide like, how do we be strategic and how do we take a systematic approach to really kind of implementing and putting capital to work in a way that actually helps to drive systemic change. But then how do we also not, make ourselves pigeonholed into an area that's so narrow that we can't actually put capital to work at scale? Because ultimately that's what the family really wants to do. They're really committed to making sure that 100% of their assets are all put towards this values-aligned approach. So that's something that we're kind of still working through right now. And then it's a multi-generational family, Gen 3 within the Walton family. All of them have some sort of varying level of interest in impact investing. And so they all have, similar but different interests, and it creates a lot of confusion in the market where someone will say, oh, we're already talking to the Walton family, and I'll have to explain, well, that's a different Walton. That's his cousin or his brother or, someone else. And so needing to make sure that we're all respectful of each other's work and that we're not doing anything to get in anyone else's way or like creating weird competitive dynamics in some strange situations is hard. So there's a lot of coordination and the need for tons of transparency and communication. And then, one of the things that we've done to address that is to create opportunities for us to collaborate collectively as a family. Like we'll bring a fund to the whole family and say, this is something we're doing. We've underwritten this. Would anyone else like to participate in this with us? But we could maybe negotiate fees down collectively on behalf of the whole family if we all come in together. Or we've also started to kind of seed new strategies and to stand up new GPs. And so where there aren't strategies, this is again like a way that I address the lack of options at scale for areas that are of interest to us. We've actually just started seeding and launching new strategies with GPs. And so there will create an opportunity for other family members to come in and invest alongside us. So
that's great, to provide another way for kind of the extended family to start to see what you're doing and become engaged slowly, bit by bit. Fantastic.
How do you deal with the generational differences in values? That family in particular.
Yeah, it's just, this is a very purple family, truthfully. It's like they have very different political and social views, and they're all very respectful of each other's views. But there's a lot of staff education and needing to be current and communicate across staff, shared services and so forth. So there's a lot of infrastructure that goes into supporting the broader family to make sure that happens.
Did that get your question? Great. I'm going to open it up for questions in just a moment. So start thinking about your questions, and there'll be mics roaming around. And for those of you who joined us a little bit later, it'd be great if you can speak into the mic, not for the volume, but because the session is being recorded. So I want to throw out a question that we don't often hear, but our panelists are prepared for it. Kind of failures in the space. So a time that you have been unsuccessful with engaging a constituency and kind of why you were unsuccessful and kind of why you failed at that point. I think we don't talk about failures in this space. We don't talk about it amongst women. Ally pointed this out on our call, our prep call, that, we hold ourselves to this much higher standard of perfection. And we heard about it already today, kind of in the large plenary. So I think it's important to actually talk about failure because we can learn from our failures. And we, at the early stage, we encourage our entrepreneurs to talk about their failures and learn from their failures. So we should too. So I'm going to throw this out to the panel and anyone can kind of start. Okay.
So polite. Yes, yeah.
I have way more failures than successes because you have to go through many, many no's to get one yes. So I don't even know how to say one example, but I would say a couple themes that have not worked is to get to the wealth advisor before the principal behind the wealth advisor. So we either, try to get to the person who owns the wealth first, or in conjunction with the wealth advisor and the person who, controls the wealth, or the person who controls the wealth first and then their wealth advisor. But if we just go to the wealth advisor first, we found that doesn't generally work. And then the other big thing is actually not speaking about impact, just because so many people still think that impact means a concessionary financial return. And so we obviously judge and gauge our audience first, but we often don't even talk about the fact that we're a, GIN certified impact fund. And we talk about the fact that we're focused in areas that are improving environmental and human health, because they're highly acquisitive, because of the consumer demand that's driving it, and really make it more of a financial thesis than talking about it as an impact thesis. And the impact piece seems to be the icing on the cake for a lot of people. Those are the biggest.
Since we're going in order, I think a current failure or an opportunity to work on would be in thinking about removing obstacles in this business and in our current business. So we just started at the end of May, yet my partner has been running strategies like this for 10 years. I've been in and around the industry for about 10 years. So we both have track records in the business. And we got in front of a few financial advisors, and we saw one firm that's a leader in the impact space and even in the gender space. And so I'm a female CEO, I'm running my company, I'm an emerging manager, I'm going to tell you all about what we're doing. I got the portfolio manager in the room. And I was like, we're going to get money from these guys right away. So I have my budget and I'm paying people, and we're going to get money right away because they're going to love us. And we went in there and they loved us, right? And this is the best, this is the most deep gender lens product we've seen. You guys think about it in a way that no one else does. We really love you. Keep us informed.
Yeah.
Like, we'll see you when you get 100 million. So for me, like, some of these obstacles are systemic, where I understand a financial advisory firm needs to have these kind of expectations for their responsibility to their clients of investing in a new manager. But we're all trying to say, we want to move more money in this space. And I'm like, this is kind of an easy way to move money in this space. Give us a shot. But there's this systemic kind of issue. And so what we've been running up against is, how do we get over those obstacles, and how do we do that, and how do we get better at budgeting and setting expectations for my investors?
Great, thank you.
That's interesting to hear you say that, Allie, because I think we, in our seats, can do a much better job of being more open and transparent too. So that's good.
Tom Mitchell just diligenced us. Okay, we're all set.
Good. We're making connections. We're putting capital to work just as we speak. I think in terms of failures, and we've talked a lot about this concept of sort of perfect being the enemy of the good, or trying to achieve perfection. And our peers that are just doing quote unquote traditional investing, they make mistakes all the time. We could probably put together a huge list of venture capital funds, private equity funds, deals that did not go well. So I think sometimes we get very caught up in trying to be, and I've had that experience with some clients where we've just gone back and forth and back. Well, this isn't quite exactly what I'm looking for. This isn't quite exactly fitting this need. And, then we're not making any progress. And so I think that's a failure on our part as advisors for not pushing further and pushing our clients to really to make a commitment and test and iterate and recognize that, yes, it will not be perfect, but it will be an opportunity to learn. And when we can reflect back, 2, 5, 10 years from now and see the impact that some of these investments have had, we may not have the same strategy down the road. We may have pivoted. We may be doing something different. But if we don't do anything to start, we're not going to have anything to learn from, and we're not going to have any, progress to move forward. And even saying all of that, though, I still think it's really important. I've had, several instances where we, didn't do as good a job working with our clients to try and define some of those priorities, and that's just led to some really difficult conversations. So in so much that, we can get over that hump and recognize that as an obstacle is really important.
Awesome.
Yeah, I think so. One of the things that we really try to do to support our work on the investment side is to use and leverage philanthropic capital to seed new market opportunities, or kind of come in early and take risk that we wouldn't be able to take otherwise. using the family's personal capital. So, there's a lot of grant making that we're doing in the space in support of our strategies. We make a lot of PRIs as well. And, one of the things that for example, for our clean tech practice is that we've been doing is to help to fund accelerators. And so there are situations that we've come up against where, we just haven't thought ahead and thought about what the kind of longer term play is for us. Like if the goal is to invest in these companies and to provide commercial capital to them at scale later, then we have to be more thoughtful about when we use that philanthropic capital and the way we structure it. Because for us, it's not just about kind of legal conflict of interest. It's about like perceived conflict of interest. We're kind of an easy target in the media, and the family is really private. So one of the things that we are doing right now is bringing in outside consultants to help us really understand what are when are the appropriate times to use and leverage grant capital and to make PRIs and so forth, and when should we step back and say to the company, come back to us in 6 to 12 months after you've gotten your PR from a foundation, and then we're happy to come in and provide you with your Series A capital. So those are just kind of some recent issues that we've come across recently, and using kind of a blended capital approach to the work that we're doing.
Great. All right. I want to open it up to all of you. So there are mics floating around. There's one right there.
Thank you. What an awesome panel. Thank you so much. Learning a lot. Whenever we think about obstacles to impact investing and from an advisory perspective, everybody always starts off with education. Education, education. What I'm hearing from this panel is that's an oversimplification of the challenge. It's not just education, it's how you approach the education. So I think that's part of what I'm getting. But if I was to oversimplify and say, when you're talking to somebody, do you start with return and then talk about impact, or do you start with impact and then talk about return?
Wants to take that?
You mentioned it.
Yeah, I mean, it depends, obviously. It's the first answer. But we have twice a year, we have dinners with all of our investors and then the leaders of the portfolio companies. And we just had one the end of October, September, I don't remember, recently. And since we're still fundraising, we went around the room to all the investors. There were probably about 25 or so in the room, and just asked them, why did you invest? Not because we want to feel good about ourselves, but because we want to learn what is it that puts you over the line. And it was really interesting to hear that it was not the fact that we're focused in sustainable consumer and consumer health, these impact markets. It was almost 100% because we're investing in women-led companies, because they not only, so most of them are women. There was one guy there, several couples, but there's only one that actually kind of led the investment decision. And so almost all the women were highly educated, had successful careers. And so they had seen in their own world that there was a really good financial opportunity so it was something that they wanted to take advantage of, but they also wanted to fix. The one gentleman that was there is a fund manager, fund reviewer at a wealth advisory firm. And he said he has looked at thousands of funds, and that this was, so he's always looking for funds that have a unique value proposition and very rarely finds one. And that this was one of the cases where it was a completely unique value proposition in this, asymmetric market opportunity, blind spot, really great financial correlations behind it. So it depends, but what we found was the common theme seemed to be the financial advantage of gender diversity and changing the current situation in VC.
I would just add on to that. It's been an interesting time to discuss public equities and ESG thematic strategies with financial advisors. And if I'm talking to the Women's Foundation of some major city, I'm talking about gender, right? And I lead with this is what we're going to talk about. But they care deeply about how the portfolio is constructed and what we're doing. With financial advisors, when you come in as an ESG manager, it sometimes bothers me that performance doesn't come up. And I tend not to lead with performance because I just don't think that's important in it's not a good practice in investments at all. But we talk about process and how we make our decisions with extra information. That's all it is. It's just another layer. It's more information about a company that you're then utilizing to make a good investment decision. They happen to reflect social values or environmental values or other sort of values, but this is just extraneous or extra information to make a better decision. And so that's kind of how we come at it with financial advisors who don't really understand, why they would invest for values.
Hello, my name is Pamela Jacobs, and I'm with InvestNet. And I just want to thank all of you and really everyone in the room. I can't tell you how impressed I am with the thoughtfulness and the intelligence and just the group. It's just really inspiring. So thanks to everybody for that. But one of the questions I wanted to ask is, you as business owners and you as leaders in our industry, what is it that you need to continue to move forward in this space? And what can we as a group collectively provide to you so that you can keep doing the good work that you're doing?
I mean, personally, I would say like more product in the private markets.
Yeah.
I mean, just and for me, it's not really through kind of generalist, kind of big mainstream PE funds. It's finding kind of specialty niche strategies that really kind of go deep on the impact side in certain areas, because it's a lot of work seeding a new strategy and standing up a GP, and we'll do it when we have to. But, I would love it, and it would really help me and my team if there were more ways to put money to work in the private markets at scale.
I agree with that. I think more product, it just makes it, easier. You have more opportunities, a better menu of things to bring, we have to bring to our clients. I think on the topic of, I know there's a panel later on measurement, or maybe it's concurrent to this one, I can't recall. But I think that's another place where sometimes, again, we can get too bogged down and trying to be perfect. And, at Cambridge, we've done a lot of work with the Gen and others to try and put, more data out there. So I think, continuing to support that, other organizations partnering and finding ways to lift up and share data is really important too.
And this is where the panel starts to diverge. So as a product producer, I've got plenty of product. And I just need more money in it. But I say that in jest and also very seriously. But if I look around and I think about the movement in the market, and US SIF posts some numbers, and I don't know, being down in the weeds, and it doesn't feel like maybe there's that much money moving in the space. And instead of complaining and pointing out obstacles, I like to think about how do we fix that? And I say to my own team, if they're spending time doing something, attending a conference, whatever, they have to be thinking about moving more money in the space. It doesn't necessarily mean to be to us, but they have to be always looking to move more money in the space. And I think we, as practitioners, everyone in this room, needs to, I've been doing this for 5 years and I see a lot of the same faces, and it's great, but where are the asset owners and where are the new financial advisors? And, is there a way that we can all commit to growing this space and moving more money to these great products and creating great products? But how do we get more people involved that have assets and help them move it this way? Maybe it's you don't show up at a conference without bringing someone that's either an asset owner or someone that's brand new to it. I mean, we have to, because it's been the same crew for quite a while. So anyway, I'm just suggesting.
Yes. No, that's great.
Yeah. But it does reflect like this idea of a mindset shift, in that, maybe it's back even at a more simple level, education and business school. I mean, other places where people are going, and that should there be a course on investing for impact that's mandatory at Harvard Business School and Stanford and Wharton and et cetera. I mean, these are all elective courses today. Is there a way that we can push so that the guy that's going to go, unfortunately, maybe to a big, name financial institution, at least has that mindset, has heard about this, has been exposed to this, because that might start to shift the conversation. It's less of just the same, preaching to the choir, as you said, Allie.
Sarah, did you want to answer too?
Yeah, I've got two things. One is just the matchmaking process. It's so inefficient right now, the coffee to coffee kind of situation. So in the larger the family office, the more hidden and hard to find. And so that's a little ridiculous. And then on the institutional side, I think there's just some policies that need to change if we're going to change, especially the fund managers' gender diversity in this world. It's going to take decades with the current attributable track records that are required and the check sizes that are written. And so we talked a little about this in Philadelphia 2 days ago. But my thought here, and I just published an article in Forbes about this last week, is to maybe gather a fund-to-fund pool of capital where then smaller checks could be deployed from these institutional investors into these emerging, women-led funds. Amen.
I'm Peg Talent from Michigan Women's Foundation. Sarah, I have a question for you specifically. Something you said earlier about not working with the financial advisors first. We have a number of big supporters. We're hoping to launch a fund at the beginning of next year. A number of our regular supporters have said, we can get you with our clients. Now you're scaring me that that's not a good strategy. So we obviously will go into the donors and the investors that we know well. But if people want to make intros to us, why does that not work?
Well, from our experience, based on what Ally shared earlier, and there's also some data that I can't remember who wrote it, but anyway, looking at impact investors and millennials, 80-something% think they'd like to do impact investing, 70-something% of women, 63% of men or something, and then like 7% of wealth advisors. And that there's actually like 60-something% of wealth advisors who think it's actively like a really not a great idea. So that's what you're up against. And so that, generally they're kind of gatekeepers that are thinking, oh, impact's a dirty word, or, oh, you're a first-time fund. Oh, no, we don't, whatever the reason is, there's a million great no reasons. And so we need to get to the actual person controlling the capital and then introduce the wealth advisor from our experience thus far.
Thank you.
Yeah.
We're going to go to the side of the room, so right here, and I can just repeat your question for you. No, you can just speak.
So as a wealth advisor in the room, I have to take issue with two things. One is it is dramatically changing. I've been involved in this space since 2009 and have been going to the same conferences, and I completely agree with Ally, it's preaching to the converted. But the number of wealth advisors now who care, who get it, are calling people like us and saying, you've been doing this for a long time, can you educate me? It's dramatically changing. The other thing is, wealth advisors have certain standards, and I don't think it's fair to say you should violate them because it's impact. So we're fiduciaries, many of us. If a client wants to invest in a $20 million fund, that's great, and we'll facilitate it, but we can't approve it for the 90% of our clients, and don't confabulate the fact that we're not
approving it with the fact that you're an impact investor. It has nothing to do with that.
And I take your point, and I agree with you on some of it. Some of these, so we were all at some of us were at a women's conference for the last 2 days in Philadelphia. It was wonderful, and talking about the patriarchy. But some of the fiduciary standards and the rules that have been set up by the firms that exist, they exist for a reason. I totally get it. But some of them are there just to say, hey, you need to have $150 million and you need to have a 3-year track record before we'll invest in you. Then all that's going to happen to the impact investing space is the big players like BlackRock and all the big players that have been managing money for a long time are going to create products. Now, I'm not, BlackRock's great. I'm not talking about anyone with their authenticity, but if you're really worried about authenticity and greenwashing and gender lens washing and people really caring about this industry and integrating impact factors into what they're doing, then any small, independent, authentic company that really cares about this space doesn't have a shot with the financial advice community unless a few foundations take a huge bet on them. And then the financial advice community is missing that huge opportunity to bring some really interesting and new managers to their client set. So there are some people like Envestnet that are changing their managers program and adjusting those rules and calling it emerging managers. And they're looking at funds and saying, not how many assets do you have and how long have you been doing this, but let's look into the people who are managing the money, what their experience looks like, what they've done before, what's the risk of the firm, what's the counterparty risk and all these other things, and saying, how can we get comfortable with putting these people on a platform because we are so committed to growing the impact investing space.
Ally, I completely agree, and it's ironic because my firm has plenty of history of doing small
guys are a leader,
$20 million and $50 million funds, and I'm defending other people, but I agree wealth advisors should be more innovative, but it's not just impact. And so these rigid $300 million in 3 years don't make sense for any kind of fund. So I think it's a different kind of an issue. And I also think a lot of wealth advisors have been doing something for 40 years and they don't want to be confused with the facts. It's leave me alone. It's worked for 40 years. I'm going to do it for the next 40 and get out of my office.
So we have time for maybe one or two more questions.
Well, this is a corollary question. So I'm just curious about what any of you would have to say about the incentive structure for wealth advisors and financial advisors in general that precludes a transition to learning more and being properly incentivized. I feel like I've sensed a gap there and room for credentialing and, dare I say, education, but maybe not a boring webinar, but more legitimate credentialing that could give people the right kind of tools to do this and to feel comfortable and confident about making these recommendations, even in spite of their fiduciary responsibility.
Does that matter?
Yeah.
It's going to take all the time, but so it's something I was just talking about. I don't think financial advisors, there's enough product support, I think, for financial advisors if you know where to look. There's enough consultants, people that understand the industry that can be there to support you in making those decisions. I think getting someone comfortable with opening up the question and to understand what their clients own. I mean, that's where you start. You understand what your client owns, understand what your client's purpose of their money is, right? So some clients might not want to own manufacturers, distributors, but some may because they think it's going to protect their children who are in the Army. So you need to understand what your client's first trying to get at. And then it's like, okay, then how do we make a recommendation to make sure that what you own is actually aligned with what your values are? And you don't have to know all the different products and how to speak about ESG to your clients or how to talk about a private fund. You just need to know who the product manufacturers are and who the people are that can help you, I think, to get you comfortable with that. And I think what you were talking about with matchmaking, I think we need to get better as an industry with kind of matching up that educational piece of it.
Hunter Lovins, Chief Impact Officer of Change Finance. To what extent are you guys looking at the possibility of profound dissolution of value driven by the advent of renewable energy, the fall in the price of storage, the electric car, the driverless car? If folk like Tony Seba of Stanford are correct, within the next 10 years, this will drive a tenfold drop in the cost of getting from here to there. The switch to 100% renewables around the world. And if that's true, the utter dissolution in value of the oil, gas, coal, uranium, nuclear, utility, auto industries, the banks that hold paper in them, and everybody who's invested in them. Beavis Longstreth, who was at the SEC commissioner, said it's entirely plausible, indeed probable, that continuing to hold fossil assets will come to be ruled as negligence. And if this is true, we are looking at the mother of all disruptions. And I think none of us have thought hard enough about how do you protect value if that's true.
So I can speak a little bit. The Waltons actually, once we kind of dug into these systems maps that I was describing earlier that we've used to help develop our strategy, the idea was for us to focus on what we always internally refer to as our North Star. And, for them, they are more interested and drawn to long-term systemic change. So we call them moonshots and totally go in acknowledging that some of the things that we're doing are moonshots. And, one of the things that we've also had to work through is like looking at incremental strategies that help to support and work towards those moonshots also has a lot of value. So we've had to work to kind of create balance within some of our strategies. Like we can't put all our direct investments can't be these moonshots, or otherwise at the end of the day, I'm going to have some really unhappy clients in the next 5 years. And I think the hard part about what you're saying is that you have to have a situation where your client has a really long-term timeline and is truly willing to be patient, because everyone says that they go into a lot of these investments saying that they're willing to provide patient capital. But in reality, what people want to see is early wins. I mean, just from my experience working when I was at Imprint, working with a broad set of different kinds of clients, people can say that they are willing to provide patient capital, but they need to see and they want to see early wins. It creates momentum. It makes them feel good about the work. It makes them feel like they're making smart, sound investments that are actually accomplishing the goals that they're seeking to accomplish. So for me, there's a balance between, satisfying my clients' interest in these more moonshot-like opportunities that address our North Star and that are looking at like these, super high-risk, technology-driven opportunities to address these long-term sustainability challenges, and also looking at ways to show that we can make short-term gains on a more incremental basis to support those strategies.
Thank you. So we're just about out of time, but I'd like to wrap up by having each of our panelists just give kind of one or two easy ways to get started and just kind of bring this back to being very, very tactical, so that you all walk out of here and you can share with your friends or bring a friend next time, kind of one or two ways that they can really just get started with impact investing. And so kind of following that trend from this morning. So whoever would like to go first can start and we can hop around too, but just very tactical, one or two ways.
I could start. I'd say, so actually, again, back to the deploying capital, and this is building on a point that was made this morning. There are so many ways you can just even simply take your cash or other investments that don't require all of these complex decisions and locking up capital for 5, 10, 15, 20 years. So start there. I think that's a very easy win. And then the second thing I would say is do more things like this. Learn from your peers and leverage many of the great networks that exist in this impact space. And so having some of those conversations and being able to talk to a peer or a friend and saying, well, for institution, whether it's, a peer institution or a peer, family or what have you, what have you done? What have you learned? How can that inform, what I may do? And then use that as a springboard to making that first investment and taking that first step.
Great. Thanks, Erin.
Mine, I'm going to follow on just real quickly because to that vein, it's for financial advisors or people that are advising people or even individuals in the room. If you know what your clients are interested in, what they care about, it could be as simple as your client's interested in the environment and you know that they're upset over maybe the Keystone Pipeline or something like that. Well, the first thing they can do is move their money out of a big bank that's helping fund that. Right, and go into a community bank where the money that they're giving the bank and the money the bank is then lending out is going to community places in your community. Like that's the first to get them start thinking. It's your consumerism. It's what they mentioned this morning. Are you using Uber and Amazon? Are you using Lyft and something else? It's those small steps to understand if they care about that and if they're making those moves, then you can move on to the CDFIs. I was supposed to mention CDFIs definitely, and then longer term stuff.
Great. Sara, Melissa?
So in my world, I'm looking and talking to a lot of people who are interested in making direct investments into companies, into startups. And so I think, we have a lot of angel investors who are looking to be angel investors or were angel investors and realize they don't have the time, skills, desire, whatever, because they're retired or they're working full time or whatever. And so having being in a venture capital fund can be a nice on-ramp to angel investing or a nice off-ramp from angel investing. And then you can have somebody who's doing all the deal flow and due diligence, or you can do some direct, doubling down co-investments. So I think.
Great.
Yeah.
Thanks, Sara. Melissa?
Yeah, I would say on the asset owner side, really, it would be great just if people would encourage their clients to be more transparent about their work and their experiences. I mean, for example, like our systems maps we share them openly with people, and we explain how they've evolved and changed over time and why we've decided to pivot and move into certain directions. We did a clean tech scan recently, and we've shared it with a bunch of other family offices in the space that are also looking at the clean tech universe of funds right now. I think just trying to encourage people to be more open source and collaborative because there's just such a lack of transparency in the market. One, that helps to move money, I think, more easily. And then two, it helps to identify where there are overlaps and opportunities to collaborate with each other, because that's where I see, particularly with the directs, that we source most of our directs through other family offices and fund managers who know that we're interested in sectors that they're also interested in. So just trying to make sure that there is more transparency and the opportunity to create more connectivity in the market from within asset owners themselves, I think is really important.
Great. Please join me in thanking Erin, Allie, Melissa, and Sara for joining us this morning.